Hello, my friends. Today is September 16th. My name is Joseph, and this is Markets Weekly. This week, we're going to talk about three things. First, we have to talk about what's happening with the Bank of Japan. It seems like the Bank of Japan is finally ready to hike rates and exit negative interest rates. Secondly, let's talk about what happened at the ECB meeting last week. It seems like the ECB, although they hiked rates by 25 basis points, it seems like they are strongly suggesting that their rate hike cycle is over. And lastly, let's talk a little bit about the United Auto Workers strike happening here in the US and how that plays into our broader view that we've been discussing for some time, that over the next few years, labor is going to have more and more power. Okay, starting with the Bank of Japan. So last weekend, Governor Ueda of the Bank of Japan gave an interview where he suggested that at the end of the year, he's going to have enough information to decide whether or not the Bank of Japan might need to hike rates. Here's some context. So over the past few decades, Japan has been struggling with low inflation or outright deflation. So in order to combat that, the Bank of Japan set rates to negative 0.1% in 2016. And of course, it did not work. But over the past few years, just as inflation swept across the world in the US, in the Eurozone, in Canada, and many other countries, it also touched Japan. And inflation in Japan has been comfortably above its 2% target for some time. Now, many other central banks in the world saw inflation coming and began to aggressively hike interest rates. But the Bank of Japan saw inflation and basically did nothing. Now, over the past several months, what Bank of Japan officials have been saying is that yes, inflation is above our target, but according to our forecasts, it's going to go back down. So we don't need to do anything. And I can totally understand that. After all, they've been trying to see inflation for a long time. Finally, inflation is here. They probably don't want to suddenly overreact and see it go back down to deflation or something like that. But I think as data is coming in, it seems like what they're seeing in Japan might actually be more durable than expected. And if that's the case, the Bank of Japan might actually have to hike interest rates. So if you're looking at wage data in Japan, for example, wages have been steadily rising. Now, if you have wages rising, then you can obviously have a situation where inflation is sustained as people have more money to spend on goods and services. There's more demand, and that could be supportive of prices. I also suspect, though, that the Bank of Japan might be a little bit concerned with rising energy prices. So we had a CPI reading last week in the US that showed some acceleration. And that was largely due to rising gas prices. So oil prices have been, steadily rising in the past few weeks, and maybe it will continue to rise. Now, Japan basically imports all its oil, and the yen has been weak. So in yen terms, energy prices have been increasing a lot. So you can easily have a situation where inflation in Japan continues to increase rapidly because of imported energy costs and stuff like that. So I think it's totally reasonable that the Bank of Japan might be thinking about hiking rates maybe at the end of the year, maybe sometime early next year. When that interview was leaked, we had an immediate reaction in the market. The Japanese yen strengthened, although it gave a lot of that back throughout the week. And you also had short-dated Japanese government bonds also spike. So the 2-year Japanese government bond spiked at that, and then gave a little bit of that back. But if you zoom out a bit, you can see that over the past few months, market participants have been anticipating the Bank of Japan to lift yields, to lift interest rates and exit negative rates. So the 2-year Japanese government bond yield is now comfortably positive. Now, when the Bank of Japan ultimately does decide to hike interest rates, I think that's going to be another upward push on global yields. After all, global sovereign bond markets are interlinked. If you are a global investor, you can invest anywhere. And we can see over the past few decades, Japanese investors have been sick of low yields in Japan, and many of them have invested abroad. as the Bank of Japan is forecasted to hike rates. On the margins, you could see some of them coming back, or at least not wanting to invest additional funds outside of Japan. And that could, of course, put upward pressure on global yields, including treasury yields. It's just one factor among many, but it's something that we should pay attention to. This is a very big change. Japan is a major country, and they have kind of been an anchor for global rates. We saw the yield curve control for the 10-year JGB widen, and now we're seeing short rates move. And maybe some people are speculating that they might scrap yield curve control entirely. So this is definitely an area that is worth watching over the coming months. Okay, now let's talk about the ECB. Now, before we talk about the ECB, let's level set a bit. So the ECB has an inflation target of 2%, and they've been failing that target miserably. So inflation in the Eurozone is far above 2% and really doesn't have any clear indication of declining to 2%. However, at the same time, the economy in the Eurozone is not doing super well. We have reports that we have a lot of data that suggests that, maybe Germany is in a recession. We have a lot of, surveys that suggest that things in the Eurozone aren't heading in the right direction. And of course, monetary policy has tightened conditions, and you can kind of see bank lending has basically ground to a halt. And in Southern Europe, many people who have variable mortgages are going to be paying higher mortgage payments. At the same time, of course, you also have, just like you do in the US, a pretty strong labor market. Wages continue to go strongly. So heading into the September meeting, many people were not sure what the ECB would do. Some people thought the ECB would do nothing. Other people thought that maybe they would hike. At the end of the day, the ECB decided to hike. But they gave very strong guidance that this is probably going to be their last hike. So one of the things I like about the ECB is that they're super, super clear and super, super blunt in their discussions. So I think it might possibly be because, the ECB conducts their press conference in English, but as we all know, many people in the Eurozone don't speak English, and there's a lot of stuff that probably gets missed in translation and in cultural misunderstandings and so forth. And so whenever Madame Lagarde or whoever the ECB president says something, they say it multiple times and they're very blunt. So here's a clip of a journalist asking Madame Lagarde,
is that the end of the rate hiking cycle, or do you leave the door open?
And what we have decided is actually reflected in that key paragraph, which I have read twice because it is in the body of the text, which was released to you earlier, and also in the conclusion of the text, which is that, and it has caveats, based on our current assessment. So it is based on all the data, the numbers, the analysis, the assessment, the projections, and any other information that we have available. We consider that the key ECB interest rates have reached levels, note levels, that, maintained for sufficient long duration. So there is the time element that comes up, will make a substantial contribution, those are heavy words, to the timely return of inflation to our target.
And so, as you can see, Madame Lagarde breaks out her statement and basically reads it to the journalist, trying to explain to everyone that the ECB is probably going to hike rates here and not do anything. But if inflation evolves really differently than their expectations, they're probably going to have to hike again. And so the market reaction to this was immediately to sell euro against dollars. And that makes complete sense because the Fed may not be done hiking, but the ECB seems to be done hiking. So we could potentially have interest rate differentials further widen going forward. After the conference too, I think it's worth noting that some ECB members leaked to the press that they would still be open to hiking rates later on in the year if inflation remains high. So I think that's one of the hard parts of doing policy in the Eurozone. So in the US, obviously, we are one country, one fiscal union and all that. But in the Eurozone, you have a whole bunch of countries and everyone has a different cultural background. Some people come from, let's say, a hyperinflation background, is really cautious of inflation. Some people are more lax and like easy monetary policy. Some countries have a lot of floating rate mortgages where hikes have a big impact on their households. And some people have, let's say, 25-year fixed mortgages in their country, and it doesn't really matter. So it's really hard to get a consensus at the ECB. On the way up, when inflation was high, it was really easy to go from zero. But I think going forward, it's going to be really hard for them to get on the same page. So my guess is this political the way to build political consensus going forward is going to be pretty difficult. So this probably is their last hike, and perhaps sometime next year they're going to have to be thinking about cutting if the economic situation there doesn't improve. And so far, it doesn't look like it's going well. Okay, the last thing I want to talk about is the United Auto Workers strike. So as this has been widely reported, the United Auto Workers began striking on Friday. The United Auto Workers, about 150,000 people. Okay, so this part of the United Auto Workers, for the big three American auto companies, about 150,000 people, and about 13,000 of them went on strike. The union seems to have decided that they're going to strike at select facilities, and this makes sense for them because if they all strike, well, so when they're on strike, they have a strike fund that pays for their employees so that they can continue to live. And so if you have a targeted strike, it's not as big as drain on that employee fund. And also they're picking strikes at locations where it's most painful to the auto workers. It seems like they're picking locations that produce their most profitable vehicles. Now, this is part of a broader theme that we've seen all throughout the summer. We saw UPS workers go on strike and get big wages. We'd have United airline pilots go on strike and get big increases. And now the United Auto Workers are going on strike, and they are offering to come back to work if they can get 40% wage increases, which is, of course, a lot. Reporting suggests that the auto companies are offering them 20% raise over the next few years, and the United Auto Workers is not willing to accept that. They seem to be wanting 30-some% over the next few years. But that's how negotiations work, right? Eventually they'll meet at some middle ground, but it looks like it's going to be a lot closer to what the auto workers want. So let's step back for a bit and see just these big macro and demographic forces that we see being manifested. So as we've been talking about for a long time, so the workforce population in the US isn't really growing the same way that it used to. And if you look at some particular blue-collar jobs like auto workers or let's say truck drivers and things like that, people are not as interested in those professions anymore. So macro scale, you don't have a workforce that's increasing as much, and culturally, people want to go to college and study English or something like that. They don't want to do the traditional blue collar jobs. So there's, in many segments of the economy, there's going to be a tremendous shortage of labor. And labor is taking full advantage of that to press for higher wages. United Auto Workers have repeatedly pointed out the big profits that their companies make, the big salaries their CEOs draw. They're pointing out that inflation over the past few years has been high and eroding their purchasing power. So they want a bigger share of the pie. Zoom out a bit and you'll see that over the past few decades, labor has had a smaller share of national income. And that's partly, technology, globalization, and so forth. But now, finally, because of demographics, labor is realizing that they have more power, and they're going to want to have a bigger share of the pie. Totally normal, and something that we're going to see more and more going forward. Now, this couldn't play out in a few ways. We could have something like a wage price spiral where they gave employees higher wages and then just turn around and raise prices to pass on that cost. We saw that happen in the 70s and 80s, and that seemed to lead to higher inflation, and that's what the central banks don't want. But another way this could play out is that, the company actually eats those costs and has smaller margins. I think that's also a pretty reasonable outcome because if you look at from a macro standpoint, corporate profits, they really surged over the past few years. So you could also have a situation where companies really just share more of the profits with their workers, and that would improve the living standards of a lot of people. So I think that would be an optimal outcome. So it's not clear which outcome we'll have, but we'll see playing forward. Hopefully it's the better outcome. But one other additional thing that I'll note, though, is that even though we'll see labor have greater power over the few years, I think that the auto industry in the U.S. is probably not in a good place. So overall, globally, what's happening is that people are moving towards electric cars. Now, electric cars are something that American auto manufacturers are not very good at. We can see Ford trying to build out an electric car business and not doing very well. So what seems to be happening is that globally, Chinese automakers are really building out their production capacity and beginning to massively export electric cars. Now, recently, China became the top exporter of electric cars in the world, and this is kind of a playbook they've done many times. Solar panels, for example. Solar panels are basically all produced in China now. The government there gave big subsidies, is willing to, maybe not pay too much attention to environmental costs, and just massively produce and export, and they basically took over the solar industry. It seems like they're doing the same strategy for cars as well. So the auto sector, as we transition to an electric car world, is going to be in some trouble, especially the American manufacturers and the German ones as well. Basically, the legacy car manufacturers that are very good at producing ICE engines, but not as good at producing electric cars. So this particular strike is probably another headache for the American auto industry. That's kind of unlucky for them. But the overall trend, I think, is for wages to continue to increase. And this auto industry here in the US is going to be in some trouble, it seems. Okay, so that's all I prepared for today. This coming week, we're going to have an FOMC meeting, so I'll produce an FOMC debrief. Once again, if you like what I'm producing here, remember to like and subscribe, and check out my blog, fedguy.com, for additional market commentary and my courses at Central Banking 101 if you're interested in learning more about asset markets through the lens of a macro trader. All right, talk to you all soon.